Hello everyone and welcome to your on-chain update for the 29th of August. So today what I want to look at is a fairly simple concept of are we running out of steam? So we've talked about for the last probably week or so that there's a few bearish divergences in play, and what we really want to assess is, we've moved into a bit of a consolidation. It hasn't really sold off yet, and that's obviously a good sign. One thing that certainly stuck with me is the fact that the Ethereum chain managed to literally split in half and price rallied 160 bucks. So, that to me is a bull market sign or complete exuberance, right? It's going to go one of two directions. But ultimately that's telling me that there probably is still some insane market strength. It feels to me like that's a bull signal, but at the same time, we have to look at the data objectively and just see whether this rally, this consolidation phase, really has the guts or is running out of steam. Is it going to be able to stick that landing? Are we in? We've had a bounce off the 200-day on the BTC chart, which is down there just above 46,000. That to me really is the key level at this point in time. I want to see that hold, but again, we'll see how things play out. So let's have a look at our some of our analysis and go from there. So what I want to look at is on-chain activity, and it's a ghost town for both chains, for both BTC and Ethereum, with the exception of the NFT craze, which, I'm seeing lots of similarities to the ICO bubble. There's just a lot of junk out there, and things are starting to get replicated. I'm seeing, mintable objects that, basically knockoff Rolexes all over the place. I don't know. I can't understand the NFT stuff. I bought one the other day, but really more just to feel the pain when the thing explodes, which it inevitably will now that I've entered the market. But, I like to test these things live in action. So we'll have a look at the on-chain activity side for both chains, which continues to just amaze me at how quiet it is. We'll have a look at Bitcoin and Ethereum and DeFi analysis. Just have a very quick revisit. I want to look at the DPI versus ETH chart, which I'm hard pressed finding anything more bearish than that chart at this point in time. I want to look at some check-on-chain momentum, so some of our momentum oscillators, and just get a bit of a gauge on what that means. And lastly, I want to do a bit of a deep dive. I've spent some time with the coin maturation waves, just understanding a little bit more about how we can really use them, and just really step through what we're seeing at the moment now that we've got some spending behavior going on. What is that telling us about the market? So let's start with our Bitcoin analysis, looking at on-chain, and then we'll jump across to Ethereum and carry on. So to really set the scene for Bitcoin, we've essentially, we're still consolidating really. You can see that there's a little bit of an arc. I'm a big fan, maybe it's my my engineer history, but I'm a big fan of using gravity, just visual gravity in price charts to really tell me something about what's going on. 2021 has been a perfect example of this. We obviously had this parabolic rise higher, and then we had this gravity form, right, where the thing just kind of lost momentum, started to trade sideways longer than expected, and now we're getting this return to the other side. If we zoom back into 6 months, you can see we've got a similar pattern. We're starting to lose a little bit of that momentum, telling me that maybe there's still some downside risk. We're not exactly out of the wood yet. We can see here that this is around the 200-day moving average, around this $46,000 level. That's really where the 200-day is. We've got a huge amount of volume that's been moved there. I do think that traders are really buying that 200-day, but I also think that if we lost it again, it would start to resemble 2019. And if any of you remember that, if we lost 2019 in 2019, when we lost the 200-day after that reclaim, that was actually a precursor to March 2020. Now, I don't know if that kind of event is coming, but that's just a fractal that's all of 2019 has stuck with me in my mind for since we had that May sell-off. It just feels like the model that we're in. And, maybe that's the fractal that could be playing out, that if we fall back below that 200-day, then we may have some more extended downside. Likewise, we've actually bounced off it quite nicely so far. Let's hope that we can actually hold it. That would be really, I think that's the bull bear bias at this point in time. Above 46,000 is probably a good sign. Below, probably not so great, especially on a closing basis. We've touched on institutions. I think this is all much the same story. It seems a bit flat at the moment. On the leverage side of things, we still have fairly elevated leverage. We're still a little bit positive. It's not screaming positive. I'm not too concerned about the derivative momentum at the moment. Obviously, increasing leverage is just a factor in markets. Do I think we're going to get some kind of massive squeeze? Not necessarily. It's possible. But we'll see how it plays out. But it's not something that feels like it's kind of excessively leveraged at the moment. We're just not seeing the funding rate spiking to crazy levels. it actually seems fairly controlled, which is interesting. You know, our options volume, we had a bit of a closeout over on Friday. Some of those options contracts were essentially expired. We've got increasing driving up on options volume, and you can actually see this is a little bit steadier. Here we had quite a lot of volatility. It obviously dropped with and without with spikes. We haven't really had that correction yet. Maybe we get a lot of closing out of volume on those spikes. But at the moment, it seems like we're getting this kind of steady climb. And I actually would suggest that as time goes on, more option volume is actually quite healthy. It's telling us that more people are using hedging risk. Obviously, there's speculators in there, but they're just losing money on the options markets. Really, people are going to be hedging risk, and that's going to prevent them from having to sell their spot. And I think overall, that's probably going to be a net healthy position for long term of Bitcoin. Now, this is actually a chart that I find quite exciting. We've got a very, very large outflow that really, you know, after a period of massive accumulation, I'd suggest a lot of this is the coinage that was accumulated back here. We then had a huge outflow. And we kind of recovered, had a little bit of an inflow, but now we've actually seen that revert back to the downside. So this is telling me that, and you can see that on our percent balance on exchanges, let's go to 1 year, we've essentially completely corrected for where we were back at 50,000. So one would argue that, you know, we spent a bit of time up here in this 50, 60,000 range. One could argue that we're probably in a similar position in terms of supply squeeze. It's actually looking quite healthy. I'm not really too concerned about the spot volume at the moment. I actually think that spot is looking quite strong. I'm certainly not in the camp of being a bear. I do think that the 200-day moving average is probably a good place to hold. It's held so far. That's certainly been my bull-bear bias and will continue to be. I think it's just a very high reliance indicator. And it's also very simple, which means lots of people are using it. Tends to be a prophecy that feels true. But at the same time, you know, we've got good supply dynamics going on. On the overall supply side, it's looking quite healthy. Something that I'm certainly excited by. Now, address with non-zero balance, still grinding higher, right? We've seen this pattern for some time, and that's not a bad thing. It's showing this dollar cost average type behavior. People are buying, people are accumulating, more are buying than spending. I think that's probably the more important thing to take away from all of this. There's more buying than spending. Active addresses is still, I mean, this is just, what is going on? Where is everybody? This thing is a ghost town. Our transfer volume, there's a bunch of people tweeting charts, and I just want to really highlight this. On-chain charts and data, there's two types, right? There's on the chart on the right-hand side, which is what you would pull from the blockchain, total transfer volume. There's a bit of smarts in there, but this is more or less just what you pull from the blockchain. Note this, just unreal high, right? Massive, massive, massive amount of volume. But then when you do entity adjustment, pretty much disappears. So what we're seeing there is essentially a bunch of internal transfers that the market is probably wrongly classifying as volume, as all-time high volume. It's actually, you know, arguably, I mean, yes, it happened, but it's probably internal shuffling, wallets being moved around, wallet management. They're actually using this low-fee environment, these institutions, to reshuffle all their balances, and it makes perfect sense. So note how our transaction volume is very low, active addresses pretty low, active entities pretty low. It's really nothing that's exciting me to a great extent right now. Now, what is good to see, we were talking about this span output age bands. In fact, we've been talking about this for, oh man, I would almost say since the sell-off in May or just after it. We were looking at what's going to be the signal that when we get a relief rally, and we were going to get a relief rally at some point, what did we want to see and what did we not want to see? And what we didn't want to see is old hands being like, that's it, I'm out. Let me get me out of this thing. Now, we've seen a little bit of that. But I would call this strategic spending. We're not seeing anything close to, let's see if we've got 2 years. I mean, nothing on this scale is really that dramatic. Even here where we put in this 42,000 top, this is a very, very discrete moment in time. We're just not seeing that much spending going on. And this is excellent. This is really, really healthy. We can see that on our relative transfer size, we're actually getting a breaking down of this large volume. And that's not a bad thing. That's showing that we're not seeing huge amounts of coins, that we're not seeing whales who are just dumping their coins, saying 50,000 is expensive. I think the bears are very wrong. I just don't see any long-term bear case. I can certainly see a sideways crab case, but I cannot see a bear case at this point. I think the supply dynamics are just simply too strong. And we still, even at 50,000 after a number of weeks, they've had plenty of time to take this exit liquidity. They haven't. We've held this line. I think that the market is stronger than a lot of people are expecting. I think downside is still good and healthy, but at this point in time, I'm certainly no bear. We can actually see this when we look at our realized profit and loss. We're still maintaining some profitability. Profits being taken, a little bit of losses being realized, but overall, it's actually good. I would call this sticking the landing. We've maintained SOPA above a value of 1. Short-term holders have got a couple of these little resets. Again, give us a little bit of a correction. No complaints there. But we're holding profitability. That means that the market is absorbing that supply and willing to keep chewing through it. So, you know, even though we haven't got the on-chain activity, someone's buying, and it's obviously of enough size that we're still gaining, well, I wouldn't say gaining momentum, we've slowed down a little bit, but we're continuing to trend higher on a, you know, swing basis, even though there are people who are spending. So overall, this is actually pretty net positive. You can see that overall on our percent entities in profit, it's basically following price, which means that there's a continued accumulation as we go. There are people who are basically buying all the way up. And we'll see if they get shaken out. But you can see here actually that just let's talk on a very macro scale. Let me just wind these all down to 1 year, just so we can get a real zoom in. Again, remember on this top row, we're looking at spent outputs, how many UTXOs of a particular age was spent, ranging from 3 to 6 months all the way to 2 to 3 years. Now, what we really want to see here, this has got a 7-day moving median applied to it. So remember, it's going to basically give us the typical value over the last 7 days. Note that we've got breaking down on pretty much all of them, right? We've had a couple of spikes of that spending, and then we're getting this falling off. Now, that is really good. That reflects what we had here in our spend outputs. Let me go 6 months, how this is trending down. We're getting less spending, reduced spending. In fact, this has got an EMA on it. Let me put an SMA on 7 days. So you can actually see, so the exponential moving average will amplify what's going on in the front end of the curve. So what happened yesterday and the day before, more than what happened last week. Whereas a simple moving average is going to smooth over the whole thing. Now, what we're seeing here is that you can see there's a clustering, right? We actually saw a clustering up here and the spending has slowed. This is what we are seeing in our moving medians. We're seeing spending is slowing, which is good, right? Some people have taken some strategic profits. Supply last active 3 to 6 months is breaking down. Meanwhile, 6 to 12 is breaking higher. That means that this is probably more maturation than spending. 1 to 2 years is trending higher a little bit. I mean, it's small, but it's moving up. Supply last active 2 to 3. You can see this is a pretty big spike. It's spending down. I wonder if that's actually maturing. We should have a 3 to 5, but we'll look at that more in our coin maturation waves as we get there. ASOL is up, but you can see that over the last couple of days it's breaking down a little bit. Coindays destroyed again. We can probably ignore that for now, just because we have so little transaction volume. Dormancy is up, but seems to be stalling out. So look, let's see if, importantly, if this continues to trend higher and we get all of these keep spending. Okay, maybe that's not great, but at the same time, the market seems to be absorbing it so far. So, to be honest, I'm not that concerned when some of these older coins get spent. What I'm looking for that mass exit, and I'm not seeing it, right? That's what really matters to me. I want to see a mass exodus, a change in conviction. Really, what Lifespan is telling us, why I look at Lifespan, is about investor conviction. Are they remaining firmly in the majority of their position? If you're taking some strategic profits, fine. If people are spending a couple of coins here and there, fine. If they're hanging on to the majority because they believe in it, and more importantly, they're accumulating, that's the kind of behavior that we want to see. It's showing, and really it shows up in our supply dynamics here. We're bottoming out on active supply 1 year ago, which means it's starting to increase. The amount of supply that was last active a year ago, meaning at least it's older than 1 year, is starting to tick higher. Liveliness is in a strong downtrend now. This is accumulation behavior. Coindays destroyed 90, strong downtrend. Short-term holders down, long-term holders all-time high. So supply dynamics, very, very hard to be a bear at this point in time. Note here, we can actually probably zoom in 1 year. We still have this macro downtrend in terms of young coins. And note that in recent days, what is this? This is our 1 day to 1 week is now transforming into our 1 month to 3 month. So this orange band here is starting to swell out and absorb this lower orange band. So we're seeing that maturation. Coins that were accumulated 1 month ago, which would be, pretty much when this rally started, near the end of July. That's when coins started coming out of exchanges. And actually, we're going to see this thing tick over in a big way when our big spike, where are we? Hang on, exchange spike. When this guy, let's assume this guy's gone into cold storage, we're going to see this thing start to mature. right? So we're going to see that guy show up, and he's not insignificant, right? There's 20,000 coins. It's large enough to show up on something like this, you know, a couple of fractions of a percentage point. So we're going to start seeing that, because realized cap is about value, those coins were moved at, you know, 30,000, 20,000 coins at 30,000. It's a non-trivial sum of money. So we're going to see that start to age and mature. And again, this guy here is really just showing us a similar story. Some of these short-term holders, note that the red, right? The red is short-term holders in profit. They're starting to come back into it. Now, remember, a lot of these short-term holders, as they come back into profit, there's a strong incentive for them to spend their coins and get out, right? And actually, you know, get out of their cost basis. Did you get shaken out? You're like, whew, that was scary. I saw a 50% drop. I may as well get my money back. People don't seem to be doing that. And once they move into profit and they stay there, that generally creates more longer term holders. So overall, the supply dynamics and the psychology remains actually quite healthy. When we're looking at things like, I mean, this is hodl waves are on a supply basis, not on a value basis, realized value basis. We're still getting, just note like the general trend of at least 1, 2, 3 yellow bands swelling, getting larger and larger and larger. These are multi-month to a year-old coins, to 2-year-old coins, and we've still got this downtrend in these younger coins, and it's actually ticked down just that little bit this week. So we're actually seeing overall coin maturation, illiquid supply chains looking good, long-term holder supply is actually ticking back up. And again, remember, long-term holder supply 5 months ago, that's going to be inside the topping range, the $55,000, $60,000 topping range. There's still people who are holding UTXOs, I mean, myself included, from that zone. So, you know, overall, it's really, really hard to be bearish on the supply side. So to me, this does not scream bear market. This screams bull market and, you know, really an opportunity for hodlers who don't particularly mind if a 20% correction comes along, because that's just another dip there to be bought. So I really think that this is a spot-driven market. I think that hodlers are at the advantage here. And I really don't think that doubting the magnitude of this supply is I'm certainly not doubting it at this point in time. My probability on bull bear is 75-25. And to be honest, the 200-day moving average is kind of a level that if that breaks, I still won't go full bear. I actually think that there's a possibility that we break it and then recover it again, simply because of the magnitude of this supply. And there's always going to be people buying. So, you know, I think that the bull bear line is there, but I also don't think that breaking it is necessarily the end of days. Even a correction down to 40,000 wouldn't be too unhealthy. Now, one thing I did notice today is a little bit of miner spending. Again, it kind of fits within the volatility of this. It's nothing that I'm paying too much attention to. Note that hash rate has actually recovered about 50% now of where it's fallen down from. So we were at 180. We're currently at 130. So we were at 90 at the bottom. So we've recovered 40. Yeah, thereabouts. So it's roughly 45% or so of the total impact has now been reverted. So miners are still net gaining, but there's been a little bit of spending over the last couple of days. So I don't think that's going to be too much to impact the market. It seems to be absorbing things. You know, again, a correction's not going to hurt anyone. So let's jump across to our Ethereum analysis and just take a quick look at what's going on the other side of the equation. Now, it's very much the same story, so I won't dwell too much on this. I think open interest is much the same as what we've seen for Bitcoin. Note that we're overall net long. Note that our open interest is kind of following price. There's probably a little bit more leverage in the Ethereum market than there is in the Bitcoin market, and I'd be tempted to think that maybe there's a lot of hype around NFTs and EIP 1559, so I'd be tempted to say that there's more probability of a squeeze to the downside. But again, to be honest, I really think that Bitcoin and ETH are moving at the same rate at this point in time. I doubt they're going to decouple. The ETH BTC chart looks a little bit sadder. Actually, we might look at that shortly because I want to look at DPI versus ETH just to kind of revisit that whole EIP 1559 concept. So this is actually what I wanted to show you for Ethereum. This is the on-chain activity side of things. And what I just want to highlight is number of active addresses looks horrible, right? This is really bad. This is really starting to break down quite badly. Non-zero balances are ticking higher. I mean, this is good. This is a nice little slope. So there's definitely accumulation. The same trend. This is the most bizarre divergence. I've never seen this before. On-chain activity, look at number of transactions. It looks absolutely horrible. Number of contract calls, they're all breaking down. Everything looks absolutely shocking. Mean gas prices up. This is NFT season, right? So overall usage of the chain looks pretty grim. Transfer volume, this is ETH transfer volume, is pretty lackluster. Median transfer volume, now this is NFT stuff, right? We're seeing this increase in the net median, and that's just lots and lots of larger transactions, these Bored Apes and whatever, all these things moving around value. There's just more and more value moving around as ETH whales get stuck into this thing. And this has to be one of the saddest chart setups I've seen in a very, very long time. So this is our DeFi tokens: Aave, Comp, Uni, Wi-Fi. Top row is number of active addresses, so call this number of active users, or people who care about the governance token. It's not users of the protocol, it's users of the token. And total transfer volume in USD. This is just shocking. What is going on? Nobody cares about these DeFi tokens. I mean, it's just breaking down everywhere. It looks awful. I mean, for speculation to be happening in this space, and I know it's happening in NFTs, to me, that's sucking the life out of DeFi tokens. And I also think that EIP 1559, people, I still really haven't heard a great deal of criticism that I kind of hadn't considered in my analysis so far about the whole EIP 1559 being the fat protocol. But I'm looking at these charts and note the acceleration in the last couple of weeks to months. It's looking horrible. So let's actually just jump across to the DPI chart now. So in my view, DPI is probably the best metric to be looking at relative to anything to understand what's going on in the DeFi sector. Because, I mean, lots of people can go out there and find these low cap gems, and some of the core devs of Ethereum even came back and told me that, you just need to look deeper into the risk curve. And I think if you're pushing your users to look deeper into the risk curve, yeah, that's not for me, mate. Sorry. I think that the DPI is a great metric because it uses market cap weighted. So we're seeing which tokens the market has valued the highest are going to be the highest percentage of the portfolio. Market cap weighting is by far the most sane, sensible, commonsensical approach. And I think most people would argue that it represents the DeFi space. And this chart looks, I mean, this is almost as bad as what Zcash looks like for 5 years. I mean, this thing just wants to break down. And this is about to probe all-time lows. And this is following EIP 1559. So just remember that all of this downside, all of this is, DeFi summer, all of this downside is essentially pre-EIP 1559. EIP 1559 came in here in mid-August, and we've seen just down. And I mean, this is a big descending triangle as far as I'm concerned. So I'm expecting some pretty bad downside for DeFi versus ETH. I think that could be good for ETH, but, I don't think I'm alone. I saw some commentary. Nick Carter did a podcast with Pomp where he discussed bits and pieces of this. He was talking about just a similar concept, not about DeFi, but just about how EIP 1559 has potentially turned up the dial of value for token holders rather than a value for Ethereum, the network, the blockchain, too high. They used to have the other problem. John Pfeffer and Lynn Alden talked about it, where the thin protocol was Ethereum, and it was, value of the network, you pay gas, but it didn't exactly translate directly to ETH price. But people were happy to transact. Now we have the other problem where value is kind of getting sucked out of the economy and being plugged into the base money. And it's going to become very, very hard. I just don't see any, let alone market cap weighted. No token can compete with this. Maybe in a short burst, right? You can always have these counter trend swings, but you can see those counter trend swings are getting less and less exciting. And I just don't agree with the idea of pushing people further out the risk curve to find, better valuations in coin number 6002. So it's just not my kind of view. Again, I've been critical of ETH for a long time and a lot of these design decisions, but I have a bad feeling that EIP 1559 is going to be great for ETH, right? I'm long. But I do think that it's going to be a net negative for the network. I don't think it's good for long-term health. And I think it's probably going to have to get redialed or retuned. And there's a whole governance debate, right? Did they stuff that up? I don't know. But that's going to have to go through that process. We'll see. Number will probably go up, but we'll see how this all pans out. So let's get across to check on chain and carry on with the other side of this equation. Okay, so Let's start with our trusty old Mayer multiple. We've been talking about the 200-day and touching on this guy a couple of times. I still think this has got to be one of my favorite models. It's just so simple and yet so effective. Plus, we've got probabilities assigned to it. Now, we can see here that we're basically hovering. Oh, by the way, I love the fact that I'm going to have to update my charts to this price has gone too high. So we're going to have to. So for the 200-day, I would like to hold this, right? 46,000, almost on the nose. We've spent a little bit of time. We haven't exactly rocketed away from it. We've had one retest of it. It'd be nice to see if we can pull back and then really get some juice to the upside. You know, we've clearly got some breathing room, right? Up to the next caution level. We're talking about 73,000. I don't think anyone's going to complain about that. But note how the repricing, just so you get a bit of an idea about how this model works, these multiples. So we've established our probabilities using our histograms, which we looked at last weekend. So what we can do is we can take those probabilities and say, all right, let's assume we want to map out a level where only 5% of Bitcoin's trading life has ever been above that level. So that we would then, let's say in fact, we can probably tell what that is. That would be a Mayer multiple of 3.4. And you can see that we hit this in 2017, dead on the nose. So 3.4 as a Mayer multiple is the ratio of price on the 200-day. So what you do is you multiply 3.4 by the 200-day moving average. So 3.4 times 46,000 is 156,000. So in theory, if price wanted to moon tomorrow, we would essentially get up here to 156,000, and that would represent the topping pattern that we had in 2017. It would actually represent the topping pattern that we had back here. In fact, it underestimated these levels back in 2013. But that's essentially what these pricing bands are coming from. We've defined a probability that we think is important. In this case, only 5% of history is above. Pretty good odds that it wants to go lower. So we then assign that multiple to the 200-day and we get our pricing band at the top here. Now note how the longer the price spends up here. Now this is a concept that we actually talked about way back during 2021 when we were rallying higher. We were talking about bouncing between these different bands. As we move higher, as the 200-day moves higher, sideways price action allows the 200-day, this very slow moving average, to catch up. And note how the pricing bands extend with it. So this is a concept that you've probably heard many times, and this is just a kind of a visual example of it. But sideways price action, corrections, pullbacks are healthy for a market. They build a stable base because they allow what we would otherwise call the mean reversion, the levels that we believe to be fair value, 200-day moving average being a good example of that, to catch up, reestablish a base, and therefore the upside potential from that springboard is actually higher. So this is really what this is telling me, is that we're actually starting to set up some of these higher probability levels where we can start saying, you know, where will the next stress test be, or the next major resistance. It's actually quite nice that our top caution level, previously it wasn't, now it is above our previous all-time high. So this is telling me we've got a bit of breathing room. Now, in terms of our downside price protection, 36,000 and 27,000. So, you know, this is telling us this is a 10% level. So let's just go with a real grim scenario. People are calling for 20,000 BTC, right? That would mean that there's, I mean, 27K or 27.5K is a 10% probability of being a generational bottom catching, bear market catching, March 2020 catching monster of a level. So in order to get down to 20,000, we've got to essentially destroy all historical trading history. Just, it has to be completely rubbed out. Note how much Bitcoin has basically traded, with the exception of the early years in 2017 and the very blow-off peaks in 2013. This guy has traded within all of these boundaries for the entirety of Bitcoin's life. So we've got multiple years. So to get down to 20,000, we've got to blow this thing completely out of the water. So just, it gives you a bit of a scale that, you know, I think that we've got further up to go. I think the risk to reward of upside overall is better than downside. Because we have this downside protection in terms of just probabilities and the basis of what's the likelihood of it going lower. So, you know, overall, I think that holding that 200-day moving average is key. But this gives you a bit of an idea of where it could go from here, and what targets and price levels to start thinking about, and what the logic is, the probability behind why they are the levels. Now, one thing I will just highlight, notice how these peaks are getting lower and lower and lower. And the previous two, we kind of just broke above this orange level. So maybe that's showing a maturity of the market. The lows are also getting higher and higher and higher. So maybe that's showing a maturity. It's showing that price is not deviating as far from the 200-day. It's showing less speculation, bigger size. To me, that just reflects maturity, right? The market's growing, it's getting older, that overall, that's a net positive. Let's do a quick touch on our 14-day, and then I want to get into the coin maturation waves as I am conscious of time. So our 14-day is breaking down pretty hard. It's almost going to get down to the zero bound and potentially even flip red. We'll see if we get actually a strong correction. This will happen. Now, overall, we're seeing this divergence continue to play out. We've got an uptrend in price. Let me just pull this guy down a little bit. We've got uptrending price, downtrending momentum. A strong rally here will reverse this guy, right? It's okay to come down, break below, and then bounce. You can see we get these false signals on occasion, right? In a bull market, this is probably not a bad example. Back here in 2020, we had this lift off the bottom. We had a couple of stress tests, and then eventually the thing did want to traverse higher. So it is possible. We can go back and look for these different examples when we come out of bear markets, right? We come or out of major corrections. We get these breakdowns, and then it continues to rally higher. Now, one thing that is quite interesting, let me just jump to our 140-day. So the 140-day is the big, the very, very large scale corrective momentum oscillator. We're still in the red, but note that we're starting to get some positive price action. Now, a big reason for this is 140 days ago, we were still up here in this topping range. But we are starting, that 140 days is actually coming up on around 10th or 11th of April, I think it is. So that puts us somewhere in this 60,000 range, right? Right up here at the top before the Coinbase listing. Now, what comes after that, right? Within 1 month, that's going to start that 140-day basis where the gradient is measured from. So at the moment, it's measuring a down gradient, right? From 60,000 down to here. That's going to start transitioning. So this thing's actually going to go green unless we really break down below this March sell-off level. This is eventually, within the next month, going to break into a pretty strong green pattern. And that's just going to show that momentum relative to 140 days ago is actually starting to kick back in. And you can just note, let's pull this guy down, that when this guy goes green, it goes and holds it. So coming out of this kind of correction would actually start to scream something on the order of one of these earlier stage corrections. You can see here that in 2013, we actually didn't even get it, but it would show, I mean, something similar to what we had here in 2019. We had this rally higher. In fact, again, 2019 just keeps showing up in my models. A rally higher, a corrective action, goes a bit red, and then we start to get this movement higher. And again, we mentioned that the 14-day in here as well. We've got some similar potential signals. It's something I'm paying attention to. Still a little bit bearish, but then you look at the supply dynamics, and it's just hard to be a macro bear at this point. So now let's jump into coin maturation waves. And I'm going to look at these 60-day. This is just looking at what was going on. It's basically using a 60-day moving median. Now, just as a reminder, I might actually just bring this up for completeness. Where are we? This guy here. HODL waves, percentage of supply. So what the HODL waves are is showing how much of the 0 to 18.7 million coins that are in circulation, how old are they? And we've got the younger coins down the bottom here, all the way to the older coins, lost coins up here in the top. And the change in waves here is going to be a combination of two things. It's going to change when coins are spent, which means they go from whatever age they were down into the youngest band, or they're maturing, which means they're going from these young ones and progressing. 3 months later, progress. 6 months later, progress, right? So there's a process of migration higher. So what the coin maturation waves is showing us is essentially what's going on with each of those bands by looking at it individually. Are they swelling up or down? Now, I'm going to start from 1 month to 3 months, and the reason being, if you look at any of these smaller time frames, they're pretty noisy, right? They're kind of, as you would expect, stuff's moving around all the time in the younger time frames. Now, what I want to express here is you can almost step through this in a sequence. So we're looking at 1 month to 3 months here. What we're seeing on the downside is a couple of people have been spending, right? So there's been a reasonable amount of coin supply that's been spent. And this is priced in the actual number of BTC. So a reasonable number are being spent by this 1 to 3 month. These are fairly new buys. These are traders. They bought the range back at 30,000. They're taking some profits. Good odds that they're going to actually redeploy as dry powder. These are trader types. If we then turn on the next band only, 3 to 6 months. Now, if we were seeing an uptrend in this 3 to 6 month and a downtrend in the 1 to 3 month, that's coin maturation. That's showing that coins came out of the 1 to 3 and went into the 3 to 6. Here we don't have that. Here we actually have nothing on the positive side. So let's turn off our 1 to 3 because we know that they're spending. These guys are also seeing a spend. Let's assume it's a spend for now. So we know that 1 to 3 month coins are being spent right now. Let's actually just zoom in. Let me zoom right in so we can see just this section. Make it that a little bit more relevant. So 3 to 6 months is also on the downside. Let's put on our 6 to 1 year. Note here that we have positive in the 6 to 1 and negative in the 3 to 6. So we could say maybe there's some spending going on, but also there's probably a much larger portion. Note the similarity of these two peaks. All these coins are transitioning across to here, right? So these coins, and note how the top, this guy's like a mountain. This guy's like a mountain with the top bitten off. That's probably the top being bitten off. So some of these coins were spent recently. They've taken that exit liquidity, but a good chunk more of them have been accumulated. These have not moved. They've migrated to be 6 months old. So now we're saying, cool, that's actually a bull thesis. Yeah, there's a little bit of spending, but the market chewed through it. So far, so good. Turn off 3 to 6, put on our 1 to 2. 1 to 2, we've got a little bit of downside going on here, but it's quite smooth. Smooth is normally maturation. Sharp, these vertical moves are normally spending of some kind. Smooth is generally accumulation. Sharp moves are generally spending. So we've got a little bit of downside here. Let's take off our 6 to 1 and put on our 2 to 3. But note how it's, let's say, roughly equal and opposite. That means that there's a little bit of spending going on, but a good chunk of it is actually maturing into the 2 to 3 year. So this is actually showing there's still coins maturing across that 1 to 2 year threshold. Take off our 1 to 2. Put on our 3 to 4. Note how we have equal and opposite. So whatever is accumulating in the 2 to 3 year, there is a little bit of spending going on in the 3 to 4 year. So what we're seeing here is there's accumulation here, which is largely picking up the 1 to 2s. 3 to 4 years seem to be spending. Note how this is smooth. This is accumulation or hodling. This is likely, this smooth downside is likely maturation into the 5-year band. This sharp spend, that's definitely spending. So a bunch of 3 to 4 year coins were spent on this current rally. This is pretty clear. That's why you get these vertical jumps. 3 to 4. So you can see here equal and opposite. So this was coin maturation. This is now spending. We do not have a matching increase in our 4 to 5. If this was actually coin maturation, this should have an equivalent jump. It doesn't. That means that a bunch of 3 to 4 year old coins spent. To be honest, given how few coins have actually been spent, I mean, what is this? This is 4,000 BTC. The market chews through that in a, it's not trivial, but it's also not a huge volume considering the daily trade. So, overall, nothing too concerning. And that pretty much solves all of it. So what we really saw here is 1 to 3 was spending, and our 3 to 4, I think it was. These are our spenders. These are the folks that actually spent their coins. I think we said there was a little bit in the 1 to 2s as well. Yes, there was. So these are our spenders. Note the magnitude of this. We're talking about 13,000 BTC from the 1 to 3s, talking about 4,000 and 600. So, overall, that's kind of the volume that the market seems to have chewed through and still maintain positive price action. So what this is not a bad metric to do is just to pay attention to over the next couple of weeks, particularly as if we get a downside correction, if we get another rally higher. I'm still cautious, no low on-chain activity, so the accumulation could be a little bit slim, but also it's chewing through it at the moment. And what I don't want to see is these older coins coming back to life. Maybe we get another leg up and they just don't believe that we need an all-time high yet. Maybe we get more spending then. But so far, I'm struggling to find the bear case. Correction, yes, bear. I'm just not seeing it at this point in time. So thanks for tuning in. This was a slightly longer one. Appreciate your time paying attention to these, and hopefully they're adding enough value that it's worth getting to the end. And otherwise, I will catch you in our daily updates, chat rooms, and in the next video. Cheers.